What tax law changes should advisors be aware of as they guide clients through year-end tax planning? Hi, I'm Joel Dickson. Today, we're discussing how to prepare your clients for changes to tax laws resulting from the One Big Beautiful Bill Act and the Secure Act. We'll also talk about the importance of tax loss harvesting and some wealth transfer strategies for your high net worth clients that may be particularly relevant this year. There's quite a lot to talk about for 2025 year-end tax planning. This time every year, we always want to talk about, hey, are we maxing out the contributions that we want to various tax-advantaged accounts? Are we making the withdrawals that we have to? Think required minimum distributions from IRAs and 401ks and so forth. And then the other multi-year tax planning or tax considerations, like reducing the tax liability in the current year by things like tax loss harvesting or managing other income. Or finally, multi-year tax planning approaches like Roth conversions and how that might do, because those Roth conversions need to be done by calendar year end. There were also a number of changes that came into play in 2025 that will likely impact the conversations you have with clients about year-end tax planning. 3 in particular I would highlight. The first is for your clients ages 60 to 63 that are still part of an employer-sponsored plan. There's this so-called super catch-up contribution that is now available beginning this year. Rather than the normal $7,500 catch-up contribution available to those over age 50, the catch-up contribution for those 60 to 63 is actually up to $11,250. Also, inherited IRA required minimum distributions. There was new requirements that came into place in 2025 around how and when you need to take required minimum distributions from inherited IRAs. The last several years, they had been largely waived, but now are back and required. And the inherited IRA rules are complex and vary based on when that inherited IRA was established or when it became part of your overall approach. And then finally, as part of the One Big Beautiful Bill Act, the SALT deduction, the state and local tax deduction, was increased from $10,000 to $40,000. But it comes with some caveats. And understanding and managing who among your clients may benefit from the SALT deduction and where there are maybe pitfalls because the SALT deduction will phase out over certain income levels. There are also a number of changes that are becoming effective in 2026 that may impact both year-end tax planning for this year, but then also how you're thinking about planning going into the new year. 3 in particular that I would highlight here. The first being that for those of your clients that are in employer-sponsored plans and that are highly compensated employees, basically those over $145,000 of income, catch-up contributions, those extra contributions for those over the age of 50, are now going to be required to be done in Roth form, that is after tax. And those contributions will not be tax deductible in 2026 as they have been in previous years. Secondly, there is a new child savings account that is coming into play in 2026. The Trump account that was part of the One Big Beautiful Bill Act, which acts like in many ways a starter IRA for those under age 18. It may be an important part of financial planning, both for children as well as for parents and grandparents in terms of giving strategies. And then the third major piece that I think is certainly worth making your clients aware of and thinking about some strategies around is changes that are coming to itemized deductions. There is both a cap and a floor coming into place in 2026. This may mean that you want to think about maybe accelerating income and accelerating charitable contributions into 2025 if these caps and floors might be binding in some way or inhibit your planning going into 2026. So a number of strategies in thinking about multi-year planning given what's coming next year. About a year ago, we spent a lot of time with this uncertainty about what the level of the gift and estate tax exemption would be. What we got in 2025 was certainty of increased and permanent lifetime gift and estate tax exemptions. $15 million for individuals, $30 million for married couples. And we still have the annual giving limit of $19,000 per individual. I think in general, there are a relook at your legacy planning is in order given these changes. The question now becomes, who pays taxes and when, where it makes sense to have your wealth pay tax now versus pay tax later versus avoid maybe paying tax during the transfer, without the complication for many, many people of how do I think about the estate tax interplay with all of these decisions. Long-term planning is really about when and how do you pay taxes to maximize kind of the after-tax wealth. One of the big risks that many clients face is the volatility of their income pushing them into higher tax brackets in the future in a way that could be managed if thought about sooner. A classic example of this is required minimum distributions, whether it's inherited IRAs or your traditional IRA or 401k. There is this so-called idea of a tax torpedo. That is, if you keep deferring and deferring and deferring, the balance may build up in such a way that when you're finally required to take distributions, it could push you into higher tax brackets or cause other tax situations like Social Security being more highly taxed or your Medicare premiums being higher and so forth. So a long-term planning that looks at stability of the tax situation so you can avoid these tax torpedoes can be a very powerful tool for maximizing after-tax wealth. Somewhat similarly, especially with like the changes to itemized deductions and charitable giving that we've talked about, how you think about the value and timing of certain deductions, and especially with related to charitable giving. For example, because of higher standard deductions and floors that are coming in on charitable giving when it's an itemized deduction, there are opportunities to maybe bunch charitable giving in different years. So maybe making more charitable giving in one year and then maybe less or no charitable giving in a following year. In addition, you might want to pre-fund charitable giving through the use of things like donor-advised funds. Managing of income and deductions over time is a very, very important part of long-term planning. Somewhat similarly, the whole concept of when, who, and how taxes are paid is critical in legacy planning. Things like, does it make sense to do Roth conversions during my lifetime? How do I think about transferring securities or, say, real estate across generations in a way that minimizes the taxes, maximizes the after-tax wealth? Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.